guys. Today I'll be talking about how to take precision entries. So just you follow this to the T, and I guarantee that you'll be able to understand the basic premises of um, taking trades with precision, right? So this is a euro dollar trade that I've taken once, and I'm looking for another trade. So once you look at this, I'll give my step by step method of figuring out when and how to enter a trade. All right, so I use, just like you, I used to use indicators, and even I got paid indicators, and also I got paid strategies and buy sell indicators, all based on various parameters. All are pretty much lagging indicators. So I was not successful in trading until I used them. But since I learned the liquidity concepts and the simplicity of markets, rather than over complexing it, I think I figured out a better way to trade. So I do trade multiple methods. This is one of the methods that I use. Pretty much, this is the second method that I use. So it's a liquidity system based entry. So it's not the smart money concept sort of a jargon of heavy words, but rather understanding how market works. So market works based on liquidity. Liquidity is pretty much the number of orders that the buyers and the sellers place on the market. So market is a auction. Now in this case, it's auction where they trade euros against the dollar. So the market tends to gravitate towards wherever the highest number of orders are. So what we're going to do is we're going to understand this basic premise of the market, and then start moving our trades according to the free flow of the market. So what we're going to really do is we're going to go with the flow. So we are not going to go against the flow of the market, but we're going to identify the flow. So if you've done whitewater rafting in your life someday, so you'd realize, there are rapids, and then there are also, slow places. So during the slow places, you could get off the boat, you could have a bath and all that. But when the rapids are the place that you should really be skilled at understanding how to navigate your boat without crashing and crashing yourself onto rocks. So that's what we should do. So we should go with the flow. We ain't gonna pedal against the flow. So in a rapid, what we're going to do is we're going to go with the best of the flow. So that's what we do. So that's what I'm going to explain you step by step here. So in this euro dollar trade in 1 hour, I'm not going to start with the 1 hour. I'm going to go to the weekly time frame here. All right, so if you go to the weekly time frame here, all right, so you see the market, these data is not really relevant for us, because that's like, in 2021. So we will just, come to the close by data. This is 2024 data. So you can see during this year, since like, um, February, January, the price has been, stagnating. Euro dollar has been ranging pretty much, but that doesn't mean that we don't have good trades. We do have plenty of great opportunities that I have taken during the last couple of days and weeks. So what we do here is we're going to identify major liquidity zones. You see that I have marked weekly liquidity zone. I recommend that you do the same. So liquidity zones are the places where the price has shown significant movement from, or in other words, if the price has bounced up or down from these zones with a significant push, we would consider them as liquidity zones. So why does that happen? Because I said that it's auction. So what's going to happen is the prices, when the instrument that we trade comes there, the retail traders and also the institutions believe that it's the best price to purchase this item, in this case euro against the dollar. So once they started buying in massive amounts, the price tends to gravitate up. So once the price gravitates up, they figure out, okay, this is too much for us. So then they reduce the buying power. So what happens is the price gravitates down. And when the price comes back to the previous levels, we assume that they will also assume the price is again in a good discounted range. So what we're going to do is we're going to buy. It's just like buying gifts for Thanksgiving or on a Black Friday. So if you miss a giveaway or a Black Friday this year, you ain't gonna buy at 200% next month. But what you're gonna do is you're gonna wait out. You're gonna wait out until the next Black Friday or whatever the giveaway or the sale comes out, and then you're gonna go ahead and buy. So this is the same dynamic that happens. This is an open market. So that's the edge that we are gonna get from this market. So you see the price has bounced from this area twice, thrice, and even four times. And also the price has significantly bounced from this area and moved down towards here, and it has wicked here and also wicked here. So in the weekly time frame, we realize that the price is between these two liquidity zones, right? That's all we know. So we mark the weekly zone, so we know whether we are close to this liquidity zone or this liquidity zone. So if we are close to the this liquidity zone, or the buy side liquidity, or the demand, whatever you can call it, then we would look towards the upside, because when we are close to this, we ain't gonna take short trades. We're gonna, if we are close to this, we ain't gonna take long trades, because we are close to the sell side liquidity or the supply zone, right? So in this case, we see that we've touched the weekly liquidity zone or the supply zone or the sell side liquidity, and we are trying to head downwards. That's all we know. So we don't proact the markets, we don't plan ahead the markets, we do react to the markets. Remember the thing, that we're gonna go with the flow. Now we're going to move to the daily time frame. So the daily time frame fragments and fractals the previous market data. You can see in the daily time frame much clearer that the price has tapped the weekly liquidity and then gone up and tapped again. So what it has done here is pretty much tap the previous liquidity high of this daily time frame. So you can say usually what traders do is they do take, some traders do take the first candle of the move towards whatever the side that you're going to take, or the other traders take the candle before that. Whatever that is, I take the widest range, cumulative wide range. So this uh, bearish candle I would take, capturing this bullish candle as well as more of a daily liquidity zone. So you can see nicely the price here. If you can see that, let me enlarge that. You can see this wick, it has tapped into this liquidity zone. So that is a efficient market. So what happens is, when the price moves down, it breaks this structure, you can see, and then goes and taps into this liquidity zone. So it's efficient, it's complete, it's done. You ain't gonna touch that again. So we're gonna look, so we're close to the weekly liquidity zone here, or the sales up, or sell side liquidity, and we are close to the supply zone. So then we're going to look towards the downside. So we've seen a daily breakup structure here, it has tapped to this liquid zone. So this part of the trade is pretty much done. This is sorted, and we have no problems with that. So that part is done. So we're going to go to the 4 hour. You can see a much fragmented area of this trade, right? So now you see, so this is what we saw, this part where this wicked into this zone, it was done. So now I'm going to delete this because it's going to just complicate the entire diagram. So this daily liquidity is tapped. So now what has it done? It has broken this structure as well, right? It has broken this structure. So now you see that it has broken this structure. It has broken this structure as well. So now what's going to happen? Let me go to the 1. All right. So now these light blue boxes, BOS, which I mentioned, is the breakout structure. So this is a higher time frame breakout structure, just forget about that. So you can see a low here and a high. So let me just draw that for you. So you can see the price heading up, right, and then it goes down. All right, so you see here it breaks the structure. That's the BOS that I've mentioned, right? So let's delete this. All right, so it's broken this structure and it has head downwards. Once it's heading downwards, you see that this has tapped to this daily liquidity zone as well. So this is an efficient zone as well. So now we're in the 1 now, right? So what does it do? So it again broke this structure as well, this lower structure, and then it went on and tapped to this liquidity zone. So what did it do now? So it broke this structure, it broke that structure, and what are we going to do? So we are going to look at this liquidity zone. Do you see any other places of disturbed liquidity. What I mean is any other opposite sort of candles. Now this is a sell side, so any buy side candles here, you don't see any stuck up liquidity here. So the liquidity zone would again be this zone. So this is my liquidity zone here. So this is my precision entry. So now this is efficient, so it has tapped to this liquidity and it's coming down. So my trade would be placed on this liquidity area with the stop a bit higher than this, because there is two equal highs here. So I'll talk about equal highs in a separate video. So it can be tricky here because the price might easily come back, just go above these equal highs, get the stops, and then move down backwards. So that's a probability that would happen. So in my case, some traders do wait for the liquidity sweep and then change of market structure in a lower time frame. That's a different story. I'm not going to overcomplicate this, but since I do keep a large risk to reward ratio, so and I keep my stops a bit high considering this zone of liquidity. You see that? You can see this candle. I would cover this as well. I would make my stop loss go above and I would go down. So this demand zone I mark from here, that'll be more than enough. That's a 2.74, 2.75. I could even go up to 3. So that would be my trade. So that's how I'm going to take a precision entry. So what I'm going to do is I'm going to pretty much set my trade here and observe how it goes. So all I'm going to do is risk 1% to take 3%, provided it goes to a loss. I do understand losses do exist, but all I need in a 1 to 3 risk to reward ratio trade is about 25% win rate. So that's, I could lose pretty much 3 trades in a row and the and still be profitable. So it's 25% is a significant amount. So but I do have a higher win rate in this case. So I'm getting close to about somewhere around 40% and even some days in 50. So we're good in this and we can make a lot of profit, but provided that you're prudent and you're patient and you don't jump into trades. So what I have done here, to summarize, I've observed the market efficiencies. First, I've observed the market direction in the weekly, the daily, and the 4-hour, and we have identified the major liquidity zones in the weekly time frame. We've marked them, and then we have figured out where we are close to, whether it's the buy side or the sell side liquidity, and based on that, we have minimized to the smaller time frames. We've come to the 1-hour time frame, which is my preferred time frame to trade this, because the lower you go, there's a lot of noise, and you might make a big mistake by considering that the trade, the direction of the trade based on the lower time frame. Also, I tend to FOMO into trades when I'm in a lower time frame below 15 minutes, because I do feel that I'm missing out on a lot because the candles tend to move fast. So what I'm going to do now is I've marked the liquidity zones, then I've seen whether they are efficient. I've seen whether all liquidity zones have been tapped before. So we've observed that it's been tapped, and now I'm taking the 1-hour break of structure here. All right, so let's consider it. So it's the break of structure. I mentioned it as BOS. So then what broke this structure? This structure was broken by the liquidity that was added from here. So some institutions and retailers thought that the price here at 1.105 was a good price to get the euro. So they bought a lot, and then the price crashed. Price crashed below this low and it broke the structure. So what is it going to do? We assume that it's going to come back to this area where they will be again aggressive in buying and push the price further down. So that's how we kept our trade. So this is a liquidity zone based trade. There's no other indicator in this, and we're going to observe a 1 to 3 risk to reward ratio trade. So I'll update you guys based on this trade. So also, to learn further about liquidity zones, trading equal highs, equal lows, supplies and demands, and also my other major break of range trading style, please subscribe to my Substack, where I will be doing a daily free of charge trade recaps based on the methods that I do. And also, I'll be sending you through a lot of important lessons that I have learned throughout the years due to my trading journey. So, don't trade goals out. And if there's any questions, drop down in the comments. And please make sure to subscribe to the Substack and to this YouTube. Thank you, guys.